quitting is rarely celebrated. It's often derided, seen as a weakness, a failure of character, or a premature surrender in the face of adversity. In the world of investing, this view is even more entrenched. Fund managers are praised for their conviction, grit, and ability to hold through the pain. Analysts learn to respect the long-term thesis, to see volatility as an opportunity to accumulate and to wear their bruises like badges of honor. But what if that very mindset is what gets investors into trouble? I recently read Annie Duke's Quit the Power of Knowing When to Walk Away, and it offers a provocative counterpoint to this conventional wisdom. As a former professional poker player turned decision strategist, Duke knows something about making calls under uncertainty. Her central argument is simple but profound. Quitting isn't a failure when done with foresight and purpose. It's a form of strategic mastery. And if investors learn to integrate that thinking more rigorously into their process, their portfolios might look and perform very differently. This video takes Duke's core insights and explores their deep resonance with the craft of investment analysis and portfolio management. It invites us to rethink how we define conviction, respond to loss, and choose to redeploy scarce capital. At its heart is a simple but powerful idea. Learning when to let go is as important as knowing when to hold on. Every investor has a story about the one they should have sold. The retailer that was too cheap to ignore but kept losing market share. The turnaround that never turned. The promising tech IPO became a case study in overhype. Often the issue wasn't that the original thesis was flawed. We didn't let go when the evidence changed. Duke's book focuses on the psychological factors behind that reluctance. Chief among them is the sunk cost fallacy, our tendency to factor in time, effort, and capital already spent, even when they no longer affect the decision. In investing, this can manifest as, I've already lost 40%, I can't sell now, or worse, it has to come back eventually. Alongside this is what Duke calls persistence bias, a cognitive inertia that valorizes sticking with things. We tell ourselves that persistence is noble, that quitting is weak. But this profoundly ingrained belief can be damaging in a probabilistic world where conditions change and new information demands action. And investing is nothing if not probabilistic. Duke proposes a mindset shift, instead incorporating the possibility of quitting into the decision up front, not as a reaction to panic or frustration, but as a planned and premeditated discipline. She advocates using kill criteria, clear objective signals that tell you when to walk away. These can be based on fundamental drivers, external catalysts, or predefined timelines. The point is to remove emotion from the moment of decision and respect the fact that a good process sometimes means saying goodbye. One of the ironies of investment behavior is how often investors do the exact opposite of what they should. We sell winners quickly to lock in gains, psychologically satisfying but economically short-sighted, and we hold on to losers far too long, hoping for a reversal that rarely comes. Duke's quitting framework helps clarify this contradiction. She urges us to stop viewing quitting through the lens of past performance and instead ask, what is the expected value of holding this position from today forward? That subtle shift in perspective is powerful. It means we can look at a losing stock and say, yes, I'm down 30%, but do I still believe in the thesis? More importantly, it encourages us to reevaluate winners too. Is there a better use of this capital elsewhere? Are we holding on out of genuine conviction or simply because the price has gone up and we're afraid to break the winning streak? Consider the classic value trap, a stock that looks cheap on every screen but never re-rates. Analysts can spend years waiting for a catalyst that never materializes while better opportunities pass them by. Strategic quitting invites us to impose discipline on those situations, perhaps by setting a timeline. For example, if there is no margin improvement or earnings surprise, within 18 months we move on. It's not a question of giving up, it's about freeing up bandwidth for ideas with greater potential. The same logic applies to high flyers. Some of the best compounders of the last decade, Amazon, Nvidia, Apple, looked expensive at various points, tempting investors to take profits. But if your thesis still holds and the growth engine remains intact, the quit signal hasn't arrived. Selling too early is just as costly as holding too long. The art lies in knowing the difference. Risk management at its core is the practice of knowing when to say enough, whether it's a stop loss, a drawdown limit, or a fundamental break in the thesis. Quitting is embedded in managing downside. Yet, many investors view these mechanisms as mechanical, even simplistic, rather than strategic. Duke reframes quitting as a risk-aware decision, one that protects not just capital, but mental energy and optionality. And this is where it aligns so naturally with good investing. Risk is not just volatility, it's the likelihood of being wrong and the magnitude of the consequences if you are. But also this, let's say you own a small cap growth stock with heavy customer concentration. The thesis depends on expanding into new verticals, but 6 months in, sales remain flat and management has started edging their language. The stock is only down 8%, not catastrophic, but your thesis is under structural threat. That's a quit signal, even if the price hasn't collapsed. Sophisticated managers often build in structural quitting tools, volatility adjusted position sizing, trailing stops, red flags, lists. The point isn't to turn the portfolio into a robot, but to support better decisions under pressure. Risk management at its core is the practice of knowing when to say enough. Whether it's a stop loss, a drawdown limit, or a fundamental break in the thesis, quitting is embedded in managing downside. Yet, many investors view these mechanisms as mechanical, even simplistic, rather than strategic. Duke reframes quitting as a risk-aware decision, one that protects not just capital, but mental energy and optionality. And this is where it aligns so naturally with good investing. Risk is not just volatility, it's the likelihood of being wrong and the magnitude of the consequences if you are. But also this, let's say you own a small cap growth stock with heavy customer concentration. The thesis depends on expanding into new verticals, but 6 months in, sales remain flat and management starts hedging their language. The stock is only down 8%, not catastrophic, but your thesis is under structural threat. That's a quit signal, even if the price hasn't collapsed. Sophisticated managers often incorporate structural quitting tools such as volatility adjusted position sizing, trailing stops, and red flags lists. The goal is not to turn the portfolio into a robot, but to support better decisions under pressure. Time is often overlooked in investment decisions, yet it's one of the most precious resources a portfolio has. Holding a position that doesn't perform, even if it doesn't lose money, imposes a cost. It ties up liquidity, mental space, and capital that could be deployed elsewhere. Duke encourages us to build time into our exit criteria. If a turnaround story hasn't shown evidence of improvement after 12 months, is it worth continuing to wait? If a new product line is still about to launch after 3 quarters of delays, perhaps it's time to reassess. Investing isn't just about being right, it's about being right at the right time. That's a high bar. Quitting recognizes that not all good ideas are good now and that patience has a price. There's another more personal reason we hold on to bad ideas. There are as investors often fall in love with their research. We spend weeks digging into 10Ks, modeling out scenarios, meeting with management. By the time we hit buy, the idea has become part of our intellectual identity. Letting go feels like admitting we were wrong. Duke does not hold back on this point. She argues that good decision makers separate ego from process. They define success not by the outcome of a single decision, but by the integrity of the process that led to it. That includes the willingness to revise, reassess, and yes, quit. This is doubly important for teams. Embedding quitting into the culture promotes humility, open debate, and accountability. It reduces the risk of groupthink or escalation of commitment, and it makes selling, often the most neglected part of the investment process, a first-class citizen in the discipline of performance. So how can this mindset be institutionalized? Several tools come to mind. Pre-mortems are one. Before initiating a position, the team considers all the ways it might fail. What would have to happen for this to become a clear sell? Identifying those kill criteria up front makes it easier to act decisively later. Checklists are another. These can include factors like declining fundamentals, competitive erosion, thesis expiration, or timeline overruns. Having a clear framework reduces ambiguity and with it, indecision. Finally, there's the investment journal, a powerful way to track thesis evolution over time. Did we stick to the original case? Has the context changed? Are we rationalizing or genuinely reassessing? These tools structure what is often an emotional decision, elevating the quality of the process. It's worth noting that not all quitting is good. In fact, one of the risks of embracing quit thinking too zealously is overtrading, selling at the first sign of trouble, or mistaking normal volatility for structural failure. Some of the greatest investment returns have come from enduring drawdowns that would terrify most investors. Think of Amazon's 90% crash during the dot-com bust, or Tesla's many near-death moments. If investors had quit too early, they would have missed out on generational winners. The answer is not to abandon conviction, but to test it. Are the core drivers intact? Is the thesis still probabilistically favorable? If so, perhaps it's not time to quit. It's time to hold with intention. Quitting in Annie Duke's formulation is not about giving up. It's about reallocating. It's about knowing that capital, time, and attention are finite, and that deploying them well sometimes means walking away from what no longer serves. For investors, that's a liberating idea. It allows us to replace dogma with discipline, sunk costs with forward-looking assessments, and emotional baggage with clear-eyed evaluation. Ultimately, it reframes what it means to be a successful investor. It's not just about finding the next great idea. It's also about knowing when to stop chasing the last one.